An extraordinarily warm welcome to the Risk Reversal Podcast. Guy Adami, I'm always joined by Elizabeth Thomas, she of SoFi. She's also basking in the afterglow of a Milwaukee Brewer team that, you know what, played really hard on Sunday in a game where they could have mailed it in, but they actually played more determined with nothing to gain than the Mets in Flushing, who had everything to gain. Of course, the Mets were in Miami. Hello, Elizabeth.
Hello. Yes, finished the season strong. I mean, I think it's because the late season games, the streak kind of fell apart a little bit. So you want to finish it with momentum in the right direction. And I think we did that. And best record in baseball, we finished that out, clinched home field advantage. I mean, it's like everything is aligning. And now we just have to finish October.
Yes, you do. But of course, then on Sunday night, as they
Yeah.
say, there's the old saying, tie is like kissing your sister. You actually have a sister
Yeah,
whom
I do.
I'm sure you have kissed, but not in that fashion. But the Packers of Green Bay and the Cowboys of Dallas, 40-40 tie. You don't see that every day in the NFL.
Well, first of all, I'm going to lose some respect from football fans out there who thought that I was like really up on sports. I didn't even know you could tie in the NFL. I didn't know that was an option. I thought you just had to keep playing. So I was just as surprised as anybody that it happened. And it shouldn't have happened. I think obviously we should have won, especially after the disappointment of last week. I thought we'd come out with like extra fire, and maybe we did. We scored 40 points, but there was another blocked extra point.
Yes. Which resulted in a 2 points for the Cowboys. It's a big 3-point swing, as they say, which would have been a difference.
It was like a game of trivia. Like, what are all these things called? What are the real rules in the NFL? There was a lateral pass by Jordan Love that was pretty tricky. That was a good one. I thought after that play, like, okay, we've got this game. We're looking good. We're feeling good. We've got this one. And I admit I went to bed, so I didn't. I didn't see the tie, but I heard about it this morning and I was very confused.
Well, in terms of momentum and, again, all those different things, the market continues on its momentous cycle. And I don't know necessarily if there's anything that's going to happen this week that's going to stem the tide. With that said, you brought this up before the show. And, if you do have a government shutdown, it means the unemployment rate, the non-farm payrolls, which are due out on Friday, if we were to continue through the week, will not come out. And I don't know if that's market moving. I really don't. I'm not trying to be funny here, but that's definitely something to talk about here.
Yeah, so there are a few critical things that continue on if the government shuts down. And just for everybody's information, that would be tomorrow at midnight. The government would shut down if they don't pass a continuing resolution or come to some sort of agreement. And one of the things that would not happen if we stayed shut down through Friday or through at least Friday morning is that the BLS, the labor report, would not come out on Friday as it normally does on the first Friday of every month. I do think that would be somewhat, it would be market upsetting in the sense of just sort of like, we don't know what to do with our hands because labor has become the topic du jour for the Fed and what we're trying to base our expectations on for Fed moves. I don't know that this one was going to necessarily change our expectations for October all that much, but still, a lack of clarity, a lack of visibility is not great, especially after what has been going on at the BLS and all of the different revisions. And, everybody's sort of hanging on this data, whether we trust it or not, it's still important data. So pushing it back because of something relatively unrelated to the BLS would, I think, not be a good thing for the market.
But on Tuesday, we do get jolts, which I think we'll get regardless. And that's something that you watch pretty closely, I would imagine. And I think the expectation, consensus like 7.1 million, I believe. I think prior was basically 7.18 million. So, you're splitting hairs here, but that's obviously job openings. So speak to that, because there was a point when there were 2 job openings for every person looking for a job. And at this level, we're almost at 1-to-1.
That's right. Yeah. So we're still okay, right? There are as many jobs open as there are people to fill them. There's probably a mismatch in those skills. That's why many of the jobs will remain open and the people will remain unemployed. However, we're still at an okay level. the labor market is not nearly as tight as it was when you referenced back. We had 2 jobs open for every person available to fill it. That's when we used to talk about wage price spirals being a concern, wage pressure being a concern. Companies couldn't get enough workers, so they were having to stretch themselves to pay the workers they could get. They were afraid to lay anybody off or let anybody go because they couldn't find anyone to replace them. That's over. And this has turned a little bit more into a market for employers. However, the reason it matters, the ratio matters, and jolts matter is because the labor market information that we get on that first Friday of every month is pretty lagged. And you're always looking for clues about what could be coming next. And not necessarily just in the next report itself, but which direction is the trend heading. And jolts is something that you can look to as an indicator of which direction it might be heading. You want to look at things like, what's the rate of people quitting their job voluntarily? If there are plenty of jobs available, people don't generally worry about quitting voluntarily. But the quits rate has come down too, and that's part of this report that we'll get in the JOLTS data. So if quits have come down, hiring is slow. We have a job market right now that's pretty frozen. And that's not necessarily good or bad, but it does present the risk that things could be tipped in one direction or another very easily. So, and you and I have talked many times about escape velocity on the labor market. The labor market changes pretty quickly. And once it takes off, especially on the downside, meaning people are getting laid off, it's very difficult to catch it. You just have to sort of let it continue, let it run its course and wait for it to be over.
Yeah, I agree with that, and I think you've obviously said that a number of times, and I'm not necessarily convinced that a rate cut cycle or a rate cut tweaking, whatever term you want to use, is going to sort of stem that tide. Especially, the delayed response, I guess, is what I'd like to say, and that's probably not the most elegant way of putting it. But the fact that we've been waiting for this for so long, and just one has to wonder if once the dam breaks on the employment side, is it going to be as cascading an event as I think it will be, regardless what the Federal Reserve does. So, that's out there as well. And we'll see what happens if and when on Friday in terms of, if we get the numbers or not. We're going to get some PMI data. I don't know how closely you watch this, but we got Chicago PMI on Tuesday. We got on Wednesday, I think, an overall PMI manufacturing. It speaks to, just sort of the robustness or lack thereof of this, manufacturing economy that we're trying to get back towards. Anything there that you're looking at?
Well, the PMI data is indicative. We're looking at sort of outside of technology, which obviously we talk about tech more than anything else. But the PMI data would be indicative of the broadening out trade or support for the broadening out trade. So, are there other parts of the economy that, if we've re entered a pro cyclical phase, then PMI should reflect that, particularly in manufacturing? Now, there have been some bumps in the road because of tariffs and materials costs and a lot of unknowns about exports and import, everything that's going on in the trade war. But if we're starting to settle down on that front, and if the economy is the way that many people would suggest, it's cyclically friendly. We've got a pro-business environment. We're going into another year of maybe enthusiasm on the earnings front, or we've got at least the fundamental strength underneath us with earnings. Then there should be cyclicality in some of this data that supports that. There has definitely been a cyclical trade that's occurred this year, things like industrial stocks doing really well. So you want the manufacturing data, the economic data to back that up. And I always remind people of that sequence of events. The market is first, the market reacts first, good or bad, then earnings, then the economy. So if we're looking for data in economic fronts to back it up, it's going to be the last thing that happens. So we know the market has been cyclical. If small caps start to do better, that's even more support. Earnings should have been better. They are pretty good this year. They've been beating. And then the economic data should show that support too.
Now, again, it depends on what type of calendar people are on, but for some companies and some traders, instincts suggest that Friday was probably month end, quarter end, although calendar wise, 30th of September should be quarter end, month end. Anything special there in terms of some of these markups or markdowns? I mean, because, again, we have an S&P that's basically at all-time highs, and there doesn't seem to be a lot out there sort of on the derail front right now.
I would actually be interested in your take on this. Every quarter, after we've had a strong quarter in the market, we start to hear these warnings about quarter end rebalancing.
Mm-hmm.
And, oh, okay, so equities have been strong this quarter. All the pension funds, all the foundations, all the institutional assets are suddenly going to pull out of equities at the end of this quarter and move the money into bonds because they're off of their strategic targets. I feel like it always ends up being the warning that never
Yep.
actually manifests into anything. So why do we keep talking about it?
I agree with
I
that.
still don't grasp it.
Yeah, and listen, I'm glad you brought that up. And I think what's happened over the years, and I'm going back to my commodities days, there was a period of time when people would try to sort of the Goldman Sachs commodity index, things would be reweighted on a couple very specific days of the month based on what was going on in different soft commodities, industrial metals, and different energy, different types of things. And then what happened is people start to game out ahead of it. So I think what's happening here is exactly what you just talked about. I think the fact that people like me, not you, talk about it so often, I think that maybe some of the hedge funds and some of the people that are actively trading sort of game things out ahead of it. So the whole thing sort of evens itself out. So if there were to be any, odd size selling orders are taking place, or conversely, painting the tape on the buy side, it's probably mitigated somewhat by people trying to take the other side of what they anticipate happening. And I think that's the type of market that we find ourselves in.
Yeah. So another thing that I would say, and I'm using some of the material that I've seen from technicians that I respect over the weekend, things like what's the next support on the S&P 500? So down to the 50-day moving average, which I believe is something like 6450. I don't know if I'm right on that, but something in that range. I don't have it in front of me. I think we are in a period where we've hit, another new all-time high. I think we're at 28 now on the S&P for the year. Are we due for a little bit of another one of those shakeouts? And is this just maybe a shakeout that happens where valuations sort of grind lower slowly? There's no big event. There's no like big day. There's nothing to point at and say, "Ooh, that's when it all went wrong." But maybe we give a little back here. And if you're just looking into the end of the year, if there's a give back right now, I think it's probably a repositioning opportunity or even a buying opportunity in some areas that maybe you haven't been present or you have not as big of a presence as you'd like to have. So watch for that in the coming weeks because technicians are watching these things like hawks much more closely and with more detail than I am. But saying that we're pretty extended on a momentum front, we're pretty extended on a high beta front. So we're at a point in the market where things are likely to go down rather than up, but that probably does present a buying opportunity for a rally that can continue into year end.
Yeah, it certainly feels that way. And again, here we are on the precipice of October. And if you've been behind the curve in terms of performance, and it's probably happened earlier, maybe even in July of this year, but people start to chase because they're forced to chase. And, as it gets later and later in the year, I think that chase just becomes more prevalent. And that's why you see some of these oddities that, again, in terms of the different metrics that we talk about, don't make a lot of sense. But, with that said, the market doesn't need to make a lot of sense sometimes. It just sort of is what it is. And maybe I get too granular with some of the stuff and maybe I overthink it. And I think that happens a lot of the time. But at a certain point, there's career risk on the table if you're not participating in some of these names. And for a lot of people, you can boil it down to the simplicity of that. And I'm not dismissing that as whatever. I'm just pointing it out because it absolutely happens seemingly year over year.
Yeah, absolutely. And I mean, the proliferation of ETFs has changed the game. And it's difficult as any money manager to be participating in a market where almost half of it is controlled by the tech sector plus the 7 names that are not in the tech sector. You can't be present enough in that without breaking all of your own rules for risk. And I've mentioned this before on various risk reversal programs that this is a market where investors are going to likely compromise their own risk appetite in order to participate in the upside. And if we can honestly look at it right now as, and Dan and I talked about this on Market Call last week, the technology hype cycle. If we can honestly look at it right now as we haven't even reached the peak of inflated expectations, then the reality is on that first upswing, when everybody's so excited about a new technology supercycle, a new innovation, it's not going to make sense. And that is exactly what's happening right now. It's not going to make a lot of sense all of the money that's flowing into the same names, or the spending that keeps happening, or even now we've got some circular funding that's going on, right? It's not going to make logical sense. It's not going to make sense to a process like Warren Buffett's or any value investor, but that doesn't mean that it's not investable. And it doesn't mean that it's going to suddenly end tomorrow just because it doesn't make sense today. It's probably going to continue on for a while unless there's some sort of shock or surprise that changes it. And some of this, I think, too, is a rationalization process where in the beginning, people didn't believe that AI was a real thing. It was a lot of hocus pocus, right? And then it becomes this reality of, oh, it is a real thing, but we don't really know how to use it. Now we're in the next phase of, okay, we're figuring out how to use it. I think the phase after that is now companies have to show us how they're
Well,
profiting
that's
from
it.
it.
The
And
return on
that's where
investment.
we're entering, is
Yep.
like, now companies have to show us how they're going to profit from this. Where's the productivity? Where's the profit and the cost savings?
And you hear more and more people talk about the concern around that. I saw Roger McNamee on one of the shows last week on CNBC, and he was talking about the fact that right now, in his opinion, the market was basically saying there would only be winners in this sort of AI race. And his history suggests that there will be some winners, but not everybody by definition can win. So he was concerned about, again, some of the moves in some of these names and some of the valuations around alongside of it. And that speaks to the ROI that you're talking about. I mean, there will be a period of time where the company's going to have to prove themselves in terms of that return on investment. Not only that, if they're not seeing it, one has to wonder, again, we talk about this, the sanctity of what that CapEx truly is. And if and when things start to slow, are we going to see a potential rollback in some of this CapEx? We'll see. That remains to be seen. One of the things that, in my opinion, and I think you share this, continues to be a bit of a warning sign, and it goes up seemingly every day on the back of news historically that would have been negative, is the gold market. And, we sit here every day and you walk in and gold's up $30, $40, $50 and seemingly unabated to the upside. And the demand, for whatever reason, continues to be there. I think I know what it's saying. I'm curious, is this something I'm just making too much out of, or is there some warning signs associated with the gold move?
I think there have been warning signs associated with the gold move this entire time. And full disclosure, I had been in gold in a lot of different ways up until mid to late spring. I exited because it was like, oh my gosh, I've made this much of a return in an asset that's not usually supposed to produce that much of a return. And after all of the volatility that happened in April, I did exit the positions thinking, you know what, I'm going to take the gains and keep them. And then gold kind of went flat to sideways. I figured there would be more of a return downward in gold, and it didn't happen. I'm back in now. A couple weeks ago, I started to enter and added to the position last week, and that's now up about 4%. So I'm very surprised that it's still stayed this elevated and that it continues to rise. I think it's up 10% in the last week or so.
Yeah,
So the
it's
warning
it's
signs,
remarkable.
it really is. The warning signs that it continues to send off are that it looks like the most attractive assets for central banks. It looks like the most attractive way to protect their own reserves, because we're in this era of weaponization of the dollar and all the different currency volatility that's happening around the globe. It also is now an alpha generator for retail traders. And it's something that I think can help diversify your cash exposure. I mean, people started to put so much money in money market funds, and this is, yes, wealthier investors doing it more than non-wealthy investors, but putting so much money in money market funds that it was like, we got to find somewhere else to put it that seems safe. And I think gold ended up being that option, especially during a period when the dollar was falling so precipitously.
Whether this is correlated or not, I'm not sure. Probably not. But the Chinese markets, and again, I'm not asking you to play
Mm.
specific stocks here, but some of these names have had extraordinary moves. Alibaba, I think, is up 100% or so on the year, and some of these other names are acting in kind. And you look at the KWEB, the FXI. I mean, obviously, all performing seemingly in the early innings, in my opinion. But now you're starting to see it some emerging markets. Brazil has done well. Argentina, like there are a lot of things sort of that we don't talk about all the time that have been making interesting moves. And that's, again, on the back of a S&P 500 at an all-time high. It might be just one of these global assets things, everything's going higher, but there might be something else at work here. Any thoughts on some of the moves we've seen internationally?
Yeah, so I think there are different forces if we're talking about China versus international in general. The idea of US exceptionalism has come under threat multiple times this year. I think that's part of what drove capital to international markets because investors were not suddenly running for the doors on risk. They still wanted exposure, but maybe didn't want as much exposure in the US. I think the China story is a little bit different. Now, first of all, China is really the biggest threat on a technology front to US technology. And there continue to be this like slow drip of announcements out of China that they're still trying to work on this AI thing. They're still trying to be competitive in that space. They're not winning and they may not end up winning, but they're going to keep fighting. So those announcements that keep coming out is like it just keeps them alive as a competitor. It keeps them alive as a threat in the tech space. The Chinese economy, whether we trust the information that's coming out or not, the Chinese economy is still in trouble. And I believe the Chinese government will continue to stimulate it until it's in less trouble. And I think that will drive some of those asset prices higher as well, as it already has. And we talked about this, I don't even remember when, at least a year ago, about how the Chinese stock market had probably bottomed. Bottoming goes through a process, it takes a long time. It had gone through a lot of that process. And here we are, it started to bounce off the bottom. I still think there's opportunity in China. I don't necessarily condone it as a feel-good place to invest, but if the purpose here is to make money and to invest in places that have more upside than others, I think that China was a good opportunity earlier this year. I put it in my outlook as a contrarian call. It's still a good opportunity if you're looking for upside and where to put capital to work.
Yeah, I agree with you. We've talked about it for a while, and it continues to seem to be. It's been flying under the radar screen. Excuse me. More and more people seem to be figuring it out and talking about it. And again, I'll just throw some emerging markets in as well. And I don't know if that's on the back of this dollar that continues to sort of cascade lower. More and more people are starting to talk about that. You and I have had some conversations as to when, if at all, that weaker dollar is going to go from being a tailwind for equities to being a headwind. Clearly, the market doesn't care right now, but seemingly what does care today, and we'll end it on this, is on what is a pretty benign day. You have a VIX that's quietly up a decent amount. Now, maybe that's just hedging this potential government shutdown. I'm not sure, but I'm not going to say one day does a trend make, but this is something that I'm watching as well. Is volatility seemingly creeping its way back into the market?
Well, this is another one of those weeks, much like last week. There's not a whole lot of economic data expected, at least even if we get the labor data, it doesn't happen until Friday. So markets are left to their own devices in between. We don't have earnings data coming out. There's not a whole lot to drive us in one direction or another. So when that happens, you get this natural churn. And I think it's happening at a time when we may have a government shutdown. So there's volatility around that. It's at the end of the quarter. So maybe there's just more money moving around because of it. And the fact that we're anticipating, again, we're still in this seasonally weak period. We're anticipating, okay, we're about to change months. Maybe October is going to be the bad one. September wasn't so bad. Maybe October is going to suddenly be the bad one. And just the sort of inability to sit on our hands as investors. That could be it. I don't see anything today that's obvious to me telling me that the VIX should be up, but I don't expect this to be the beginning of something more sinister, if that's what you mean.
That's a great word. Simon Bar sinister for you home gamers out there, but we'll talk about that at another time. She is Liz Thomas of SoFi. Her and Mario do extraordinary work. We're fortunate to have them with us a few times a week, which is great. And of course, from the state of Wisconsin, which is seemingly dominating the sports landscape right now. ET,
So great.
you're the best. We'll talk to you soon.